Welcome to this explainer. If you've ever stared at a mortgage rate, a business loan, or even just the yield on your savings account and thought, where do these numbers actually come from? Well, you are in the exact right place. Today, we're taking some of the most dense, highly scrutinized Federal Reserve data on the planet and translating it into a really clear, structured story about the true cost of money. We're going to travel from the very core of the U.S. banking system all the way out to everyday consumer loans and massive long-term global investments. It's a pretty bold question, right? What actually drives the true cost of borrowing money? It can feel like this invisible magical force, but honestly, it's a highly transparent mechanical process if you know where to look. So as your guide today, I'm going to help you demystify these complex structures. We're getting right into the raw numbers to see how a single percentage point at the very top cascades down to impact literally almost every financial decision we make. And absolutely everything we're diving into today comes straight from one source, the H.15 release. Think of the H.15 as the ultimate foundational document for understanding the cost of money in the U.S. It's this daily publication put out by the Federal Reserve Board, and it gives us an exact snapshot of selected interest rates and borrowing costs across the entire economy. It's basically the raw dashboard that economists, bankers, and investors are constantly staring at to figure out the financial weather. To make sense of this dashboard, here is our roadmap. First, we'll go inside the H.15 release itself. Second, we hit the federal funds epicenter. Third, we'll look at the bank prime loan rate. Fourth, we're mapping out Treasury maturities. And finally, number 5, factoring in inflation. Section 1. Inside the H.15 release, looking specifically at the May 26, 2026 snapshot. Okay, let's dive into this. The H.15 isn't just some arbitrary report they put out whenever they feel like it. It operates with absolute bureaucratic clockwork. It's posted every single day, Monday through Friday, at exactly 4:15 p.m. Eastern Time, unless it's a holiday, of course. And whenever you look at these yields, you are always looking at them in percent per annum. This kind of ironclad consistency lets the entire global financial system synchronize its watches every single afternoon. Moving on to Section 2, the federal funds epicenter, the foundational rate. If the entire economy is an ocean, 3.62% is the exact spot where the stone gets dropped. This was the effective federal funds rate for the week of May 22nd in our snapshot. And I really want to emphasize this specific number because it is the absolutely crucial baseline for everything else we're going to talk about today. It stayed remarkably steady at 3.62% that whole week. But what does that percentage actually mean? Well, if you dig into the Fed's own footnotes, this 3.62% rate is defined as the volume-weighted median of transaction-level data collected from depository institutions. Okay, that's a bit of a mouthful. Simply put, this number is exactly what banks are charging each other to lend money overnight. Banks are constantly trading reserves back and forth, and this is the median rate of those actual real-world trades. It literally forms the absolute floor of our entire borrowing ocean. All right, Section 3, the bank prime loan rate, reaching the real economy. So transitioning from those exclusive behind-the-scenes interbank rates over to the consumer side, we suddenly hit 6.75%. Notice that massive jump. While banks are charging each other 3.62% overnight, this new number is the monumental anchor figure for the rest of us. If you're an everyday borrower, or say a small business owner, this is the number you really need to care about. Now, what's really interesting here is the definition hidden right down in footnote 7 of the release. It totally pulls back the curtain on who actually sets this prime rate. It's not just decreed by the government. No, it's the rate posted by a majority of the top 25 insured U.S. chartered commercial banks based on their assets. Basically, the absolute biggest players in the banking industry collectively established this benchmark. And the reason those top 25 banks matter so much to us is that this 6.75% prime rate acts as a base rate. Major banks use it to price consumer and short-term business loans, so it directly impacts the terms of everything, from your credit card's APR to a local bakery's line of credit to variable rate mortgages. When that 3.62% epicenter shifts, you better believe this 6.75% prime rate ripples right along with it. Let's keep moving outward. Section 4. Treasury maturities, the long-term market ocean. Shifting our focus to the broader long-term market, let's look at Treasury constant maturities. As a quick refresher, this is where the Treasury takes yields and interpolates them from a daily yield curve to give us fixed maturities. Basically, it provides this smoothed out, super reliable map for investors. It gives us a precise yield for exactly a 10-year maturity, for instance, even if there isn't a specific bond out there with exactly 10 years left on the clock. It's just a brilliant way to standardize the data so we can compare apples to apples across time. Let's move to and see how this builds. Looking at these chunked data points for May 22nd, watch how the yield actually behave as the timeline extends. So a 1-month commitment pays you 3.72%. If you lock your money up for a full year, it bumps up to 3.86%. 5 years gets you 4.27%. 10 years hits 4.56%. And man, if you commit for a massive 30-year time frame, the yield climbs all the way up to 5.07%. And this brilliantly illustrates a fundamental law of finance. Just look at that steady staircase climb from the 1-year to the 10-year to the 30-year nominal yields. It proves that, generally speaking, borrowing costs rise as time extends. It makes sense, right? Investors absolutely demand a higher return to compensate for the uncertainty of parting with their money for 3 entire decades compared to just 12 months. To quickly summarize that upward trend, as the borrowing timeline stretches out from 1 year to 30 years, those nominal interest rates steadily climb from 3.86% up to 5.07%. This curve is essentially the entire market's collective prediction, pricing in future risk, economic growth, and the time value of money. But there is one massive variable missing from these nominal yields, which brings us to our final section. Section 5, factoring in inflation, the final variable. So how does the market actually account for the erosion of purchasing power over time? Well, the H.15 elegantly splits U.S. government securities into 2 distinct buckets. On one side, you've got nominal treasuries. These are actively traded, but they do not account for inflation at all. Then, on the other side, we have TIPS, which stands for Treasury Inflation Protected Securities. These are specifically designed to automatically adjust based on inflation. By putting these two side by side, the Treasury basically lets us separate out what part of a yield is just paying you for your time and what part is specifically compensating you for expected inflation. So the crucial point really reveals itself when we compare these 2 10-year figures side by side. The 10-year nominal yield is sitting there at 4.56%. But the 10-year TIPS, the one that's completely shielded from inflation, is only yielding 2.16%. That is a massive, massive gap. Why does that gap exist? Because if you subtract the inflation-indexed yield from the nominal yield, it tells us exactly what the financial world thinks inflation is going to do. Check the math. You take that 4.56% nominal rate, subtract the 2.16% TIPS rate, and you are left with exactly 2.40%. That 2.40% represents the market's precise collective expectation for average annual inflation over the next 10 years. It's an incredible, real-time look right into the mindset of the global economy, and it's all just sitting there in the columns of a single daily snapshot. We've traced the Fed's ripple effect from the overnight rate banks charge each other out to the prime rate for consumers, way up the curve of decades-long government debt, and straight through the hidden layer of inflation. You now have the actual tools to read the financial dashboard that drives the global economy. So I'm going to leave you with this. Knowing that these invisible forces are actually totally visible if you just know where to look, how will understanding these daily snapshots shape your next long-term financial decision? Thank you so much for joining me on this explainer, and hey, keep questioning the data.